right, welcome everybody. It is exactly 4:30 and possibly seconds have gone by. Thank you for joining us today. This is our last one for the year, actually. It's kind of funny. Happy holidays, Merry Christmas, and happy belated Hanukkah to all. Yes, it is rapidly finishing. I don't know. We went from pandemic to now we're 2 years past the pandemic, and here we have the most extreme volatile markets in my lifetime. It's pretty crazy, especially when you get moves that we see in the S&Ps that we've endured over the last month or so, or since November 18th, actually. Slop back down, straight back up, but lots of chop in between. Usually what we did, Bonnie, hello again. Usually what we like to do is answer questions. There were some emails. There are some questions. And there's one that's not quite anything to do with Pug, but I'll answer the question nonetheless. So we'll begin. If you could, I just want to make sure that everyone knows last Pug meeting of the year. So get your questions in. My assessment would be that if there's the next one won't be until probably maybe the third or fourth week of January. So if everyone's good on what the person's user group is for, it's to go over any indicators that we have, how I use them, what they do in helping traders give an edge. And this time around, what I wanted to do was to cover some of the inputs that go into the algo optimizer. While that's not a true Pug users group subject matter, I think it would be kind of important on developing, at least for some that use the algo room, what some of the indications, the trailing stops and the colors mean, and that might be something that we can get into as well. So with that said, before we get any further into it, let's make sure I made mention Merry Christmas, everybody, and happy holidays to all, and happy, prosperous, healthy New Year in 2021. Many of you spend just a quick second, may have gotten the jab, maybe get a little bit with the vaccine. I feel uncomfortable calling it a vaccine because it truly isn't a vaccine. It's a booster, I guess. It's not really, the booster's not even a vaccine. Nothing's a vaccine. It's just a chemical composition to help us not get as severe symptoms with the COVID. That's more of an accurate statement. So for lack of better words, if you do get the booster, some people, or the second shot or the third shot in some cases, some people feel ill, and I just hope to gosh, everyone we get through this and eventually we hear about regular cold and flu season one day. By God, it should help NyQuil sales, at least, if we ever get back to cold and flu season. So, and my little attempt at humor there, I just want to wish everyone a healthy and happy holiday and New Year's. So with that said, Merry Christmas, everybody. Let's first off let you know that trading does involve risk of loss. Trading comes with inherent risks, right? So let's get into a couple. First, I'm going to bring this in with an S&P 500. And I think it's a good way of, we'll start with this format. And everyone can kind of take a look. We have a couple questions here to go through. One is about a compression stop. So let me go back to that email so I can actually answer it correctly. And by the way, it doesn't mean that you can't ask a question. If someone had a particular question and wanted to ask a question, now's your chance. Type it in the room. And I will take care of that right away. All right. Oh, here we go. All right. This one is it's kind of interesting. right. Could you please describe the difference between your 3 stop loss models? Okay, well, that was easy. I don't know why that was so hard to open that email. All right. When we get, and I think there's also another thing that people have been asking about the volume indicator as far as the PUG or the, what we used to do is have an annual VIP membership. And so when we get Microsoft that's coming out with their new upgrades, TradeStation's coming out with one, I think it's in February, I believe it is, another one. What we decided to do this year was, instead of having all of these things in every time and every year, it was just as a public service announcement, first and foremost. We no longer have a lease fee. It's a one-time done. It's called a lifetime. And what does that mean? We give you an ELD file, and as long as you trade and have an account with TradeStation, that is your file. That's your ELD. And 2 years go by and you don't trade, you open up the ELD, and those files will work. We're not doing the lease anymore. So that is the VIP, is an annual fee. I think that's what a lot of people have come to realize, that we got rid of the VIP, I believe, is what happened. So that the volume indicator is a part of the annual, no longer an annual fee. It's a one-time fee. It's just to throw that out. If you want more details on that, Mary's the one to ask, generally speaking. That's the bottom line. All right, next. Let's get into the compression stops. So we're going to go over here, and we're going to edit strategies just to show you this. So, like I said, the VIP is no longer an annual lease fee. It is a one-time fee. And once you own that, that's it. So if you were it's an individual that asked, how do I get a hold of the volume indicator? Why isn't it a part of everything? It's part of the VIP, and the VIP had all the indicators, the TSI and the LCDs and the high close dojis. We just did an enormous amount of work for those extra products, and that's all been wrapped up into a one-time fee. So that's it. That's so that hopefully answered that question. Tech support will stop, and I believe everyone that wanted to did upgrade and has upgraded with the VIP. And you can do that, and that's where you will get the volume indicator. All right. Now, let's get to the other question at hand. And so when you open up the little box, and I'll show you how you do this again, right click, and we're going to go to studies, and we're going to edit strategy. And then if you have multiple monitors, this little box will open up somewhere obscurely. And this is version 2, number 18. So we're on the right version. And if you take a look down here, the question was, what is the difference of the stop losses? So we have last conditional change. So what is the last conditional change? Last conditional change, just as a definition, was a market that closed greater than a prior past high. The low of that bar became now new support. And you could see the last conditional change until a new last conditional takes over. And then a new last conditional change takes over. And as you can see yesterday, or excuse me, on Monday, the market broke out, pulled back, generating a 60-minute sell signal, but never closed below last conditional change support. Another launch to the upside. All right. What is the difference between last conditional change and dynamic exit? Well, now we understand, hopefully, I defined what last conditional change support is, and how do you find it, and where is it? So let's go here. Let's cancel this. Let me hit OK there. And I'm going to expand this chart. So we'll just focus on this particular setup that's going on right now. And then you'd say, what the John, are all of these lines here? On a strategy, this is a long. That's the initial stop loss. That was the first intended profit target. But rather than getting out, On this particular strategy, it jams an emergency stop in the market. It also overrides and has another different trailing stop mechanism, this little gray line there. It's gray and the other one's blue, and I know it's probably hard to tell the difference, but if you look here, this is a closed greater than prior high. The low of the bar becomes now new support until you get a new close greater than a prior high, another last conditional change, another close greater than a high, and then a new last conditional change occurs until it's violated or a new one is established. And a new one establishes because this bar closes greater than that high, and now it's got a new that should be, you should be seeing that as blue if your monitors are good. And then as you can see, here's another one up here. It's blue, it closes below it. The last conditional change of this teeny itty bar was finally violated over here. All right, so we've got last conditional change. That's where the color coordination is. If I go over to studies and I edit studies, not strategy, a different box will come in. And this box says edit studies and strategies. So we have already a bullish last conditional change is on. I'm going to turn it off and notice that it goes from showing you the last conditional change to not. I'll hit close and they reappear. So for the sake of defining and answering the question, what are the three different stops in our strategy? Sometimes people want to see what the last conditional change is and say, hey, I want to be stopped out if the market breaks below the last conditional change. And that's fine. That is written in the code of the Algo Optimizer, and you can use that. Now, what we found was that there was a combination between the last conditional change, and there's a big spread between the last conditional change that it started way down here and a prior last conditional change over time. The difference of the two would be somewhere in the middle, and most likely it's these guys right here. So let's take a look at what those guys are. So we're going to go to studies and we're going to edit studies. And I'm going to bring the box in for transparency. It keeps wanting to go up into a different monitor world. And I'm going to turn the last conditional change bullish off, hit status off. So now what are we left with on this chart? I'll expand this all up so we can see it. So basically what you have are the PPS buy and sell arrows. There they are. The arrow pointing down is a sell. The arrow pointing up is a buy. There they are. You have the blue line for the strategy indicating its initial profit target. You have orange, which is an emergency stop, which we'll go over in a minute. And then you have red, which is the initial stop. So if you're going to buy here, that was your at least your risk factor. And as you can tell, I mean, in the old days, we wouldn't normally have a 7 S&P handle risk factor in the market. That's the kind of volatility that we're having. We're not seeing just quick little moves where you get a 1.5, 2 point move in the market. You're getting 6, 7, 8 point wide range stops in the spider, which now, because of the valuation of the market, one or two things are going to have to change probably in 2022. And I would imagine the committees on the S&P 500 are hard at work figuring out, hey, we got like 8 stocks that are 60%, 9 stocks, whatever it is, maybe 40%, 50% of the valuation of the market. And you know which they are. You can go with Facebook, Apple, Microsoft, FANG stocks, Amazon, etc. In the meantime, all I wanted to really point out to you is if you choose to say, hey, it entered a long, where's my risk? And then that's where your risk is. The question at hand, though, is, John, what is the difference between the 3 stops? So first, in order to explain that, I had to start with what is the last conditional change. Since all of you are Persons User Group members, you're probably familiar with the last conditional change. It's something I wrote in a book 17 years ago. Jesus, where did my life go? 17 years ago that book came out. God, I just didn't have any gray hair then. I don't understand it. Let's go over here to edit strategy. Box went to a different window. We're going to customize, and we get a new drop-down menu. So now we understand what last conditional change is. On this particular program, which is called the Person Algo Strategy System, it has a 0, which means it defines turning something on as true, false. False is 0, true is 1. Now, to be honest with you, this is an option, an optimizable feature. If we put, use a stop loss as last conditional changes, I would push in 1. I don't know if a strategy works better using the last conditional change. It works good in a lot of cases, but I found, Ben and I both found that in our back testing, it was a combination of the average of older last conditional change stops, because what happens when you get into a situation, as I just pointed out to you, and this might make sense to everyone, and I have to close this up. What happens in the case that you get one tiny little bar like this guy right there, which is really not a meaningful market, which would have placed a stop in the market and you would have been stopped out here, right? Versus maybe the average of older last conditional changes. So what's more profitable? Getting out on every single one or picking and choosing narrow range? This is what I would consider this one single bar right here at 11:30 on the December 7th, yesterday. The bar that at 11:30, if you look at the range, it's pretty narrow relative to the prior bar. Prior bar is a wider range. So if this is still a last conditional change, but because it's such a narrow trading range, it would have been a very tight stop. What would have been a better stop? Under that low, under this low, or maybe a little bit lower. So that's where the difference between a last conditional change can be helpful for most times in the market trading, but for longer term trades and as well as for more, defined trailing stop functions, we came up with discovering that it was the average of last conditional changes, and that's where we came up with what we call the, drum roll please, dynamic exit. The dynamic exit is a function of the average of price of older last conditional changes. That was dynamic. So you'd say, okay, so why do you have dynamic? If 0 is false, which means don't turn it on, and 1 is true, we do see that dynamic exit in this model, it is turned on. 1 is true. But why do we have using a compression exit, and what is compression exit? So once again, we have what last conditional change is. It's a support off a bar because of certain criteria that needs to form to make it a last conditional change. Number 2, we've taken the average of older last conditional changes, or out of the money, let's say further out of the money, and taken the average of them, and that made that the dynamic exit function. Thirdly, we had this thing that said, well, what if over time, you get the market, and you could see clearly that we have over time the compression exit. What is the compression exit? It takes the dynamic function and it jumps it up as time goes by. It increases as time goes by, and as another function occurs, average true range. Now, if I change this ATR from this setting from 10 to, like, say 1, just for practical purposes. Okay, now you will notice that I have a compression exit that was tagged right here. Why? What alerts you to a compression exit? The yellow bars. So the yellow bars, when it has that compression exit, it's going to have the compression exit as the market's moving up. It makes a compression exit or compression exit. And then when the compression exit in time on the next open occurs, it's going to get out. What is compression exit? It's a combination of using the last conditional change with ATR. What ATR? The ATR of this market. Now, 1 is not really the average true range. What is the average true range? Average true range can be defined as the range between the high and the low. The range can be considered between which if the 2 is greater, from the high to the prior bar or from the range of the current bar. So what is the average true range? If the word says average, it means it's more than 1 bar. And what we use is a 10-period ATR. If the 10-period ATR in this case, let's say, is 3 points, 3 SPY points, from the entry, the compression isn't going to kick in until we make at least from that entry 3 SPY points, and then it's going to jam a stop in there. Now, this is another function that is, go back up to studies and go to edit strategy. Window came up in a different, and we're going to go back to customize. Now, in this particular strategy, it's, again, I just put 1 in here, 1 ATR. This wants 10 ATRs before it kicks into gear. If you notice that this market didn't generate a 10-period ATR. So this is another function, ATRs to start. When does the compression exit start? I don't know. It's optimizable. And so I use a half of an ATR up to 10 with a 1/4 point increment. And if we actually go to maybe 12, we'll see if maybe because of the increase in volatilities and swings, we'll find out what's best to still use. Should we be using a shorter time frame ATR, a higher ATR, lower ATR? What should we be using? Well, first and foremost, I didn't do something. I'm just doing this just to show you the process and where it came up with. Number one, I'm asking for this to give me rather than the current environment, I went through the entire data range that's on this chart. But at the end of the moment, we go back to studies and we hit edit strategy. Window went into a different box and we hit customize. And you'll notice here that it's still, even though I had my jump rate from a half to 12 at a 1/4 point, it still came back and landed on best profitability as a 10 ATR before the compression kicks in. So in this case, the compression exit did not kick in on this particular strategy. So the compression exit is based on last conditional changes, wider last conditional change, like an older one, and will, as soon as we get a 10 ATR movement. So if the ATR is 3, as soon as you get 30, and in the ATR is, I think, 1.9 actually. So as soon as we get 19 S&P handles, the compression is going to kick in. So right now, what's working in the market? If the market, this emergency stop just tells you where the initial emergency stop was. And then now we know that these gray lines is the dynamic stop has taken over. Tomorrow morning, if the market by chance opens, let's just say the market opens tomorrow below that gray line, opens right here, let's say at 464, it's going to immediately get out of the market. Why? Because it's at or below the stop level of the dynamic movement. So in the strategy that we built, I'm not sure. I don't know. How does copper trade? Does it trade with a strong ATR trend? Does it trade with a weak one? Does my last conditional change work better for crude oil, copper, AMD, Spider? I don't know. And what I can tell you that I do know is that I let and have through the technology of TradeStation, I can build my own idea to say, hey, by the way, why don't we let TradeStation help me figure this out, right? And let me go back here. Hold on a minute. And edit strategies is what I'm looking for. and let me optimize it to find out what the best sequence is. Last conditional change work best for copper? I don't know. We can optimize it. Does dynamic, should we be using more than one stop? I don't know. Let's optimize it. You can actually use the function. Can I optimize 3 of these at once? And the answer is absolutely. That's how we come up with the idea. As you see, 0, don't turn it on. 1, yes, use it. Or should I use compression? Sure. With how many ATRs to begin? That's why it says use compression exit, ATRs to start. It doesn't mean it's not going to use a strategy stop loss system. It says it's this particular compression one won't kick in until it optimized out, and I did it in front of you, 10 ATRs, and then the compression takes over. So different markets trade differently because of again, the ATR and the nature of the trading ranges during a trading session. So there might be periods where there's low volatility, and if you have a low vol, small, narrow ranges, then the last conditional change probably is not going to work because there's going to be too many, really too close a stop. The dynamic exit could work in your favor, but again, they're going to take the average of those really tight stops. And then the compression exit might be your best friend in a smaller, and in this case, both smaller and wider. But again, over history, and I did do the history of this since, I don't know how far back this went, 2 years, 3 years. If I wanted to slice it up, I should only say, hey, right now we have a higher ATR environment. Maybe I could tighten these stops up. Maybe I don't need to use a 10 ATR, because when I'm using, just to explain what I'm trying to define for you guys, is if I have a strategy, bear with me, you'll see what I'm getting at, that's going back since 2015, I know that the ATR, and that's what we just did. We just did a back test study live in front of you guys, or not a back, but an optimization function, that if I wanted to change this to only, let's just look at the last 6 months, because we all know in the last 6 months, the last 9 months, the last 12 months, the wildness of the value of the swing of the market is a lot greater than it was in 2015. It's a lot greater than it was in 2016, 17, 18, and 19. So since 2020, we've seen wild swings in the market. And so if you want to say, what's the best strategy for this environment, you can't do a backdated or a back test study in a new ATR environment that's as high as it is right now and say, what's the best strategy right now going forward with, wait for it, the assumption that we're going to remain in this type of volatile environment with this type of wide swings or average true range. So that is the first thing that you have to understand with what this means. If you ask the question, what is first, you have to know what last conditional change, that's where it all started from, which we gave that definition and explained that. The second thing is, where did you get dynamic? We explained that. And the third thing is, we combine the dynamic with both ATR and time. But if you're not familiar with what average true range means, that's where you need to brush up on your studies to have a better comprehension of why it's valuable. If you had a market that has let's say an 80-point 10-day ATR in the E-mini S&Ps, and you say, don't put a stop in my long position until it has 800-point move, because that's what 10 ATRs would be. If the average true range is 80 points right now in the S&Ps, let's say, and you do a back test to say, hey, don't even kick my stop in until it goes to 10 ATRs. What's 10 of 80 ATRs? It's 800, right? If I did my math correctly, 10 times 8, 80 is 800. Can you imagine not having a stop work for you in an environment that we're in right now in an 80 handle E-mini S&P? Now, I can't guarantee next week we're going to start to see the ATR continue to increase to 100. I don't know if by January we see the ATR dip back down to 25 or 30, which is more like its 7-year norm is around now 30, 29 point something, 29.86, I think it was last month. Normal times, we go through heightened periods of volatility is when you see markets go down. Markets generally go down a lot farther and faster than they go up. This year is unprecedented. We're seeing the ATR or wild swings both up and down. I mean, case in point was, again, looking at Monday's higher open. So the range itself might be small on a higher gap open, but with ATR, the calculation, once again, just as a reminder, is if it is a narrow range bar and it's got a huge gap, it would say, but John, it's a small ATR. Well, then you didn't get the point of how ATR is calculated. It's the greater of the two, the range of the current point in time or the difference between the prior days or sessions close to the actual high. Now that gives you a range that you can sink your teeth into, right? So it's the greater of the two, and I want to make sure I reemphasize that. All right. Take Me Fishing asked a good question, and part of our training that we would do, not in obviously this forum of a pug, is to define, and it's a question I'm going to answer because it's a great question. And yes, we have a book on the algo, and it's in a PDF. We used to send it out, and it's in a PDF format. But after getting a strategy, it's called maintenance. No one said you have to rewrite the program, but everyone should maintain, and anyone, and I mean everybody in the algo world knows that you need to maintain. And we haven't taught this in a while. We used to be very adamant about it in teaching in the not the live trading room, but in algo sessions, where in the futures, for example, when you have rollover, which next week we have the option expiration. Today's Wednesday. Tomorrow morning is Thursday. This is a great time, if I'm not mistaken, to discuss rollover. What is rollover and quadruple witching? Well, rollover is when we take a quarterly expiration, and in the case of, let's talk the futures, the E-mini S&Ps and the spiders. Ironically, tomorrow morning when you walk in the door on the open outcry session, 9:30 Eastern Standard Time, you will find your platforms should be rolled automatically for you to the March futures contract. So if you're looking at the ES, unless you actually show ESZ21, you will be changing that for your more active. And all the brokerage platforms want the retail traders to change immediately. Well, if there's a difference between the March futures and the December futures, that discount or premium can wreak havoc when you insert one day a 10-point movement on a moving average, and then the next day there is no 10-point difference because you've rolled over from a December futures to a March futures. So what I recommend for optimization for maintenance is to make sure that you go and change your strategy into the March contract probably by Tuesday of next week. Why? Because you can still see there's volume that will be trading in the December. There will be still volume trading in the December on Friday, and there will be still trading volume in December on Monday. By Tuesday, midday, Wednesday for sure, that's when we start to see the December futures slowly dissipate, and most of the daily trading volume will be in March. So take a little experiment, put up the March futures contract on a board, and then put the December with volume. And what you will see is they'll be like, hey, there's still a lot of decent volume in December. They told me to roll out. Well, the brokerage firms want you to roll out because they get ahead of their job, but you don't have to change it. So when it comes to not modernizing, but when it comes to maintaining is the right word. When it comes to maintaining a strategy, You want to make sure that a good time to maintain is to make sure that is the ATR environment the same? Did it change? Number one, is there a rollover period? That's why a lot of strategists use the cash market rather than the futures because of that premium or discount between the spot futures, which in this case is December. Why is it called spot? Because we're in the spot right now, or the spotlight. I don't know. It's always been called spot. I can't even tell you why it's called spot, because we're in that spot month right now. This is the front month. This is the spot we're in. It's December. If you're trading December futures, it's kind of like not the future. It's the current. It's the present, right? December, because it's this month. What would be the future? The future is March, because that's out in the future. So if you're trading futures, you want to be trading the future, which is March. Now, we roll over. No one said you had to get out on first notice day, or excuse me, on rollover day, but you definitely want to monitor your volume between now and say Tuesday, just to see what it would be if it didn't happen to be the first time in my career. Generally speaking, I've always never rolled out and started trading the March contract on the first day of rollover. I still will use the December contract. And you will notice that there will still be adequate volume there to do both March and December. It kind of gets split. So a good time to do maintenance is during those off weeks where you're in rollover period, and as well as quadruple witching, which a lot of funny things can happen to the market. Next week is December 17th. It's what we would call a traditional quadruple witching week. So you're rolling out for real of December futures to March futures. The December contract is expiring. The December options are expiring. It's all cash settlement, and that's why quadruple witching can wreak havoc on traders and trading systems, because you're getting this flood of tide changes of people doing all kinds of funny things between options and expirations all at the same time. So it's a good time to do maintenance checks. If the average true range, meaning the market's still 80 points today, it's 80 points next week, what do you need to do to change maintenance? Not much. But if the ATR goes from like an 80-point, 10-day 80-point handle, and we all of a sudden in 4, 5, 6, 7 days, we're down to 30 again, you can't be using the same type of strategy or profit targets on a system when you go from a period of high volatility or wide ranges to narrow range environment. And that's why it's important, why we have in a lot of our analysis and our work, we have that ATR bar that you can put in on the market. For example, if you wanted to put a bar on Thinkorswim, a trade station, let's go to add a study. I haven't done it in a while, so bear with me. I believe it should be alphabetical, or it's either ATR or there it is. They spell it out. One of the platforms just puts ATR and the other one spells it out, I think. So we're going to put it ATR, and you're going to hit OK. And here's average true range. And in the SPY, you'll notice where it says 14. Now, I said it was 1.96, so it's 1.71, but I don't use a 14-period ATR. Now, I think we've done this before in PUG meetings, and what I wanted to just demonstrate with you guys is simply this. Wells Wilder, who created the average true range concept, because he wasn't really a stock trader, you see. He was actually a commodity trader. And back in the 70s, we would see these things called limit up moves. Like, for example, the market closed here one day, and the next day it opened there, but it was locked limit. It couldn't go any higher, and no one was dumb enough to sell it, so it didn't have any range whatsoever. The market opened, and it closed right at the same price. It had no range. So how do you account for a limit up move with no range? You take the greater of the two, a range, which it didn't have on a limit up move, or the difference between the high and the prior bar's close. And that gave you a range. So soybeans back in the old days had a 30-cent range, and they locked limit up the next day. your range was 30 cents that day or that ATR time period. So ATR, Wells Wilder used a calculation of 14 because he called it, and I quote, half a cycle. What is a cycle? What did he mean by that? Pretty much 28 business days to the month. Boom, it was a month. It's half a month. Well, since we trade 24 hours and we're not trading commodities, and we trade now, except for in the 90s, we finally got smart and stopped trading on like Good Friday. The markets were open back then, and they gave us a vacation finally in the mid 90s. Average true range can be recalculated, and I do use a 10 period on average, just to let you know. So most of the work that I do, whether it's my radar screen, is 10 period ATR. I adjust things to make logical sense. Many of you in the live trading room caught this the other day. My 60-minute bar is not a 10 period ATR. What is 10 periods on an open outcry? Like a day and a half. What's 35 bars a week? If there's 7, it's really 6.5 hours of trading in a day. But think about it. 1, 2, 3, 4, 5, 6, 7. The last 30 minutes is considered a bar. So in a given trading day, it's 7 1-hour bars. So if you're asking what is the current volume relative to the last 10 period, I mean, you're asking for just a day and 3 hours of data. So I would use an ATR and I would use a volume of 35. So on a 60-minute basis, a 10-day or a 1 week, for example, ATR or volume study would be 35 using a 60-minute time frame. If I wanted a whole week worth of data, it would be 35. That's logical. I think that might make sense to people. So if you're ever looking to do a strategy in a system, make sure that you just don't use inputs that would apply for an end-of-day strategy when you've got a 60-minute strategy. If I used a 35 time period daily volume, that's going back 35 days. Now, 35 days is not one month or so. There's 20 business days, 5 business days to a week, and you're asking for 35. You're almost asking for 7 weeks, aren't you? So you better understand how many trading sessions are in a calendar when you start dancing around with those numbers, all right? So if you want to know what the last week average bars were in the last week, and what that volume is, for example, you wouldn't use a 10 period ATR on a 60-minute chart. You'd want to use 35. All right. Now that I got that out of my system, let's examine the point that I wanted to make as well. If I'm looking at the ATR, and Wells Wilder used 14, and that's not what I use, and this is a 60-minute bar, I want to know what the ATR is on a 60-minute bar. Do I want to know what it is for the last 14, which is 2 days? What are the hourly bars over the last 2 days? That's what 14 in this bar represents. So you go to studies, you go to edit study, pop-up window went to another monitor, my bad, average true range, customize, what do you want to look at? Well, on a 60-minute bar, I want to look at, go to general or inputs, excuse me. And if you want to look at like more than 2 days, don't use 14. What you'd want to do on a 60-minute bar is use something like at least 3 to 5 days. So that would be 35, right? What's the ATR for the last week? That's what, if you ask that question, then 35 is what? 7 bars times 5 days, a week of trading, 5 business days of trading, okay? It's not a calendar week. It's a 5 business day, all right? And then you would hit OK, and then you hit close, and now it says 35. And over the last week, the ATR is 255. It had a peak high of around 355. So based on the last couple of days, between yesterday and today's action, the ATR has started to unwind. So moral of the story, if you're looking for an ATR, again, when ATR in a calm bull market and it's starting to get a little squirrely, you start to see a rise in ATR. It's a sign of increased volatility. So when volatility or when ATRs start to expand, it's showing you it's more in a market's fall, a bearish environment. We still have an elevated ATR despite the fact it's off its highs. It's still elevated relative to its past history since October. I mean, even in October when the market went down, we're just back to an area. So another day or two, if we don't see the volatility or the ATR spike back up, then the odds are that we're not going to see a pullback or a slight sell-off. My assertion of the market is that we should, based on volume studies, we should see another retracement back down to retest these lows. Volatility is still, by definition of ATR, still expensive and high. All right. So again, when you're going through a program and an optimization, what is the environment you're in? A strategy that's looking to take out a buck or two here in this low IV market or low ATR or low trading range environment will be okay. Trying to use a 1 point stop when the ATR is increasing, all right, and starting to take out highs, just like a price pattern. If that's a swing high, that's a swing low. When you start taking out the high, you know you got something's coming down the pike. We're seeing an increase in volatility. By the way, VIX traders would use something very similar to this. As you start to see the ranges expand, people get a little bit nervous. And what do? They either buy volatility for protection because it's increasing, or they buy puts for protection because increased trading ranges means nervousness in the market, and markets go down a lot faster and further than they go up. And that's one of the reasons we look at ATR. So when it comes to my program, we have last conditional change stops, we have dynamic stop, and we have the compression, which says, hey, don't even turn on until we have 10 ATRs. Now, 10 ATRs right now would be 255. Are you out of your mind? No way. You're not going to have a trailing stop kick in until you're 255 spider points, and then it'll finally kick in. No wonder there are no compression stops in recent months, right? Because the 10 ATR is just too damn expansive, right? So when we do get back to a more normalized market in history on a day-to-day basis, the 10-period ATR will come back to vogue. So you want to do in futures, you can't use a back test study for a specific month. It doesn't have enough history. Take me fishing. I mean, literally, the March futures contract of 2022 was not around 2 years ago. So if you wanted to do a back test study of high volatility, low volatility, and see if your strategy works over a period of time, you have to use a continuous contract, and then you would do some forward optimization, and then you would do some time splicing. Thank you for that question. So that makes sense, right? I mean, if you went with so I can explain that, that's a good question to share with people. This is the @ symbol. It's a continuation program. Now, this model, don't look at the performance and the signals, because I just went from a SPY to an ES. If it has a nice trade, it's a coincidence. But what I wanted to point out to you is this is the continuation pattern of or the continuation contract. So when we went from December, when the September futures went off the board in September, we rolled out of September into December. So when we went through all of that prior period, at least if you change this to ESH22 and hit enter, you'll notice, see that the trading ranges over here back in July, ... There were no trading ranges. It just, it doesn't have ranges. It wasn't actively traded. It gave assignment values based on the front contract month value. So again, if you did a 5-year back test study, you're not going to get your right data. It's dirty data. It's not correct data because you're using a product ESH that wasn't trading 6-7 months ago, let alone 3 years ago. So if you're looking to do a 60-minute strategy in a back test, never use that particular month of the commodity market because it didn't exist. It just isn't there, and you might have a skewed result. So you need to use the continuation, and then you could take, okay, I got a decent strategy. Now let me take a slice in time from October 1st through and random through maybe November 20th. How did the system fare with this signals do well in that time period? And you do a time slice and you do a forward optimization. All right, that's another class for another day, but you deserved the answer because you took the time to type the question. So thank you very much for that. All right, well, I think we've given people, if not a headache, at least a decent look-see. And by the way, so what I'm going to do is just close out this file, close workspace. You go, John, didn't you forgot to change everything? And I'm going to just close the workspace out, and I'm not going to save it. So the only way you make a mistake is by doing something fast without reading. Sometimes I do that, and then I go, Jesus, what did I do? But I have a backup folder, I have a dipstick, and I have strategies that I've saved. So just in case I forget to read, do I want to save this? Because sometimes I want to save a folder that I've added new stocks and deleted stocks, and I want to go on my main page. And in this case, I don't want to save the changes because I don't know what I did over here. So I'm going to hit no. End of story. So we just closed it all up. It's all gone. Here's what I wanted to share with you on the page on the radar screen, average true range. I have range just to let you know when you on the TradeStation package, I put up what I thought was important information. I want to know what the interval, well, you got to kind of have it. I think I know what it is, so I can tighten it up to create more real estate. I can move that over. It's daily. It tells me the last price, the net change, both in value as well as percent, the range, the volume, and many of you already know this, but I'll just show it again. On an end of day, I'm using 10-period volume. I'm looking at the current volume relative to the last 10 days. What does 10 days represent? Not calendar, but 2 weeks, 10 days back. It'll give me a good sample of the current environment over the last 10 trading sessions. So maybe the week before was like a small movement market. Maybe it was earnings, big market movement, and maybe it died out. What's the average of volume over the last 10 days? If the average daily volume over the last 10 days is 3.1 million, and Box today, for example, was down 1.5% and only did about half of its 10-day average volume, that's a weak sell-off. On the other side of the coin, Ambarella, which was up 18 cents today, did 600,000 shares. It does 1.3. Wow, it didn't even do, no one was trading in there today, right? So it was a very low volume trading session. So I like to know what the condition of a market is relative to current volume to 10-period volume. Oh yeah, we're on the subject of average true range. What's today's range? And what is the 10-day, in this case, let's see if I follow my own work, 10-day ATR. So again, just to share with you, 10 to me on an end of day for swing trading, for position trading, 10 days is pretty important. So whether it's ATR or volume, what is the range over the last average 10 days? Maybe one day was great and the 9 days were bad. One day does not make a career. 1 month doesn't make a career. A year doesn't make a career sometimes. There is a period that you go through that some people are better than others at some things, and some people struggle during other things. But on average, if you stick to a plan that makes logical sense, it won't fail you through history. And the three things that I would say that is important is stops are not for sissies. And that's why we built in stops with logic that made sense that I wanted to be able to maintain. I mean, I don't know. I mean, does it make sense if you have, I mean, Amberilla, since we're on Amberilla, I don't know why I got on Amberilla. I just picked it up. It was there. So for the first time in history, I mean, we needed semiconductors throughout history. All of a sudden, it's discussed that now we need more chips, maybe because of everyone in the world doing Bitcoin and cryptocurrencies and more demand for technology and computers and people working from home. I don't know if that's going to continue to go up forever and skyrocket, but we have an unprecedented time period over the last 5 months that we've gone, especially 1, 2, 3, 4, maybe 5 months, where we've expanded a movement that is out of its precedence for the last, say, 9 years, right? It's not normal to see this. It's had a few times where it's run up and then cyclically come right back again. Bottom line, I'm just using this as an example, is if this was a daily chart, and if I was looking on the average, what is my current environment? My current environment would be the last 10 bars, right? A 10-period ATR, that's what the subject is. So I'm just showing you graphically, why is it important to look at ATR? Because if you were looking at trading ATRs in this time frame, all of a sudden you start to see we were narrow, and then all of a sudden it started to expand in here, and then it got even greater, and it continued to be great. Now it's over accelerated. So identifying what your current environment is important, and that's where the 10-day ATR will help. If you're not sure, you can always get a graph, and I shared how to do that by right-clicking on TradeStation and going to Studies, and then adding a study and going to ATR. If you're interested in that, by the way, on Thinkorswim. So can you do it on Thinkorswim? And the answer is sure. Let's teach you how to do that. Now, I'm pretty sure with Thinkorswim, if I'm right, we're going to go to Studies. We're going to add a study, and we're going to go to A, and I'm going to make the hyper jump if I can do it from this column to that column. I did. And it's probably, it's A to C. It's ATR. That's what it is. So TradeStation is nice and spells the whole thing out. Thinkorswim just put ATR because, I don't know, maybe the guys in the old days, Frankie, maybe the boys and the girls put it together. It says everyone knows what ATR is. We don't need to say average true range. So if you click on ATR, it's got Wilders, so you know it's Wells Wilders because he's the guy that did it. And no, lo and behold, it says 14. Well, how did TradeStation and Thinkorswim both know to put 14? Or why did they know not? Well, how do they not know they should change it to 10? Because they're just going to put the writer's original thoughts and didn't modernize what this was for. So can you change that ATR? And the answer is yes. You go up to Studies, Edit Studies, and you go to ATR, go to the cog wheel, and you can go right up here and change that to 10. And so you can have it with a big, fat, wider width. You can have it in purple. You can have it in pink, and do whatever you want. Change it so that if you're watching on balance volume, you know, at the very least, you know, you're what the indicator is, or if you can't see, it labels what ATR is. So even with a stock, you can go back and say, gee, this is a daily chart. It's the last 10 days. And you can look at the history of the ATR. So as the stock price has gone up, it's gone up in a pretty wild fashion. But recently, it's gone through this period of choppiness, and you may not see it, but it's at one of the highest ATR readings. And in history, when it gets into that high of a reading, it's kind of sold off. So characteristics, you could say, hey, something's not right now, because in stronger upswinging bull markets, we generally see ATRs on the low end, not the high end. And that's another little lesson on how to, even though that's not my indicator, ATR, I use the function of ATR in our indicator, but I thought I'd just give you a quick demo on how you could use that moving forward. I want to say that does conclude our time. Happy New Year. I'm sure we will see many of you and talk and chat between now and the end of the year. But I wanted to say for those that this was our last PUG meeting for 2021. The next one will be in January. If you have any further questions on our services and products, our holiday hours will obviously we shut down for the New Year and Christmas week for the office. And with that said, for those that were interested in knowing about where did and how we rolled the VIP package rather than the VIP being a annual lease product, it's a one-time fee now. It's one and done. That's it. You can certainly talk to Mary, call her, and I know a lot of you have already converted and found that to be helpful and immeasurably helpful. So with that said, I thank everyone for attending tonight. I hope I answered some good questions. And again, thank you for your engagement, Take Me Fishing. And I hope I at least entertained, or if not entertained, but at least directed you as to what some of the value or functions of technical analysis has and an impact in marketing in helping people to determine trade decisions, number one. Number two, risk functions, and as well as answer the question on originally, which was, what the hell is the difference between your damn LCC, the dynamic, and the compression? So with that said, thank you all very much for joining us. Merry Christmas, happy holidays. That concludes our session. We'll have a video recording posted of this event probably sometime tonight or tomorrow. So thank you all very much.